Hey, come here. I need to show you this article. According to data from the US Census Bureau, 20% of American households are currently earning passive income. To be clear, passive income is money that you earn without having to work for it all the time. Once you set it up, the money comes in on its own. For example, if you rent out a house, the rent you get each month is passive income. Or if you write a book, you can keep making money from it whenever somebody buys it. It's like planting a tree that keeps giving you fruit every year without much effort. So 1 in 5 households is earning money while they're sleeping. If you're new here, I'm Sid, and you're in luck because I've made a list of 6 passive income investments to make your future income grow. Make sure to stick around to the final passive income investment because it made a janitor into a multimillionaire and can do the same for you. Like, seriously, no bullshit. So, you always had a dream of achieving financial freedom, but you struggle with where to start. You work a 9 to 5 job and you just know there has to be more to life than living paycheck to paycheck. Well, today, we're talking about the concept of investments that lead to passive income and 6 possibilities for making money while you sleep. For each investment, we're going to explore the positives of it, then we'll look at the downsides. And finally, we'll share actionable insights that you can actually implement and give it a score from 0 to 10. Up first, dividend investment. Dividend investing is one way to pursue financial freedom through passive income. Just so we're on the same page, dividend stocks are companies that pay out a portion of their profits to their shareholders, aka you. So just to be clear, by buying and holding these stocks, you will get paid. These payouts come monthly, quarterly, or annually, and there isn't a set amount that a company pays out. Just like any financial investment, there are pros and cons, so let's break them down, starting with the pros of dividend stocks. Dividends provide a regular, often quarterly income without the need to sell your shares. This is particularly appealing for retirees or those seeking to have extra income, and they offer a financial cushion that grows independently of when the market goes up and down. Also, by taking all the money you get and reinvesting into dividends, you can significantly accelerate the power of this method by compounding. Compounding is where your income generates even more income over time. Another pro is that generally, companies that consistently pay dividends are perceived as financially stable and less volatile. This reliability can be comforting for those of us that want to be careful with our investments. And in some jurisdictions, dividends benefit from lower tax rates compared to other income types. So depending on where you live, this can be a nice benefit for investors seeking tax-efficient ways to grow your income. Now let's talk about the cons of dividends. While sometimes they're taxed favorably, dividends are still subject to taxation, which can eat into your passive income. Other kinds of income, like fancy stuff like unrealized capital gains, they're not really taxed until they're sold. Dividends are taxed the year that they're received. So fixed dividend payouts may also not keep pace with inflation, potentially eating away at the power of your passive income over time. This is kind of like a silent thief that can diminish the real value in your income, particularly in high inflationary periods like we've been seeing recently. Also, investing in high dividend yield stocks may lead to missing out on growth opportunities because instead of the company taking the profits and putting them back into the company, they're giving it to you as a dividend. To counter this, you may see some of the high growth companies reinvest their profits into the business rather than distributing them as dividends, which can lead to significant increase in their value or capital appreciation as it's called. That's why you see some financial experts argue that dividend stocks and growth stocks functionally are pretty much the same thing when you look at their total earnings. One pays you out, whereas the other just keeps that and increases the value of your investment. Keep in mind, companies have to act in their best interest and can reduce or suspend dividend payments in tough times, which can directly impact your income. This is often in response to a financial difficulty and can lead to a decline in the stock price. This kind of double dips into your pockets. So navigating the dividend landscape requires a blend of strategic thinking and personal reflection. There's no one right answer. You have to weigh how much risk you're comfortable with and consider your financial goals, your risk tolerance, and investment horizon. Are you seeking steady income or is capital growth what you're aiming for? Let's make this knowledge actionable. Here are some practical steps we can take. Step 1, diversify your portfolio. Don't put all your eggs in the dividend basket. A mix of growth and income generating investments can offer a balance between safety and potential high returns. Step number 2, research before you invest. Look beyond the dividend yield. Investigate the dividend history, the payout ratio, financial health to ensure that it can sustain its dividends. Step 3, consider reinvestment plans that automatically reinvest your dividends into additional shares. This will kind of harness the power of compounding without lifting a finger. Step 4, stay informed. Economic conditions and corporate health change, so review your dividend-bearing investments to ensure they continue to meet your financial objectives. Hey, this is Future Sid here. This is a list of all the dividend aristocrats. These are companies that are in the S&P 500, essentially the largest 500 companies in America, and they have increased their dividend payouts to shareholders for at least 25 straight years. They tend to be large, established companies, and many are nearly recession-proof. They have steady profits and they grow their dividends in good times and bad times. So hey, future Sid here, let me take this a step further. There's also a list of what's called dividend kings, which are firms that have increased their dividends annually for more than 50 years. Do what you want with this info. So my grade for dividends is 8 out of 10. Okay, so let's move on to our second passive income idea, real estate investment trust or REITs. They essentially give you passive income through real estate without the hassle of direct property management or dealing with your renters. REITs allow individuals to invest in portfolios of real estate assets. So these could be anything from apartment buildings to shopping centers to hospitals to hotels. But like any investment, REITs come with their own set of advantages and disadvantages. So let's delve into the nuances of REITs as a passive income source. REITs are renowned for their high dividend yields, a result of the legal requirement to distribute at least 90% of their taxable income to shareholders in the form of dividends. This makes REITs an attractive option for income-seeking investors. Unlike direct real estate investments, like owning a rental property, REITs can be bought and sold on major stock exchanges with ease. This liquidity allows you as an investor to quickly adjust your position in response to market changes. So if the market goes crazy, you can more quickly adapt. REITs also give investors a chance to diversify their portfolios beyond traditional stocks and bonds. Real estate markets often behave differently from other financial markets, so REITs can provide protection against volatility when the market is not stable. Another thing to consider is that for many investors, owning commercial real estate is really out of reach. However, REITs give everyone kind of access to these same high-value properties. They essentially offer you a share in profits from malls, office buildings, and more, and they're managed by professionals who handle all aspects of property management and acquisition. This removes the burden of being a landlord while still allowing you to be an investor and to benefit from real estate ownership. Dividends you receive from REITs are taxed as ordinary income. The way they are taxed may hurt your net income that you receive as an investor. So while they offer liquidity, REITs are also subject to the same market volatility as stocks. So economic downturns can lead to significant price swings in REIT prices affecting your portfolio value. REITs are particularly sensitive to changes in interest rates. So rising interest rates can increase borrowing costs for REITs and make other investments more attractive by comparison. Because REITs are required to distribute most of their income as dividends, they retain less capital or money on hand for property acquisitions and development. This can limit growth potential compared to traditional stocks. Investing in REITs also exposes investors to risks specific to the real estate sector, such as changes in property values, occupancy rates, and regulations. When considering REITs as a passive income source, we have to weigh their potential for high dividends and diversification against the tax implications and market sensitivities. Your investment strategy should align with your financial goals, risk tolerance, and time horizon. So how do we do that? First up, we can consider diversifying across various types of REITs, like residential, commercial, healthcare, to mitigate sector-specific risks. So instead of just investing in one type, we can invest in multiple types. So if one's having a hard time, the other can balance it out. We can also consult with a tax advisor to understand how REIT dividends will impact our overall tax situation. Staying informed about potential changes in interest rates helps quite a bit, as these can significantly impact REIT valuations or how much your REITs are worth. It's also smart for us to look beyond dividend yields to assess a REIT's overall performance, including its management team, property portfolio, and financial health. I give REITs another 8 out of 10. Our next form of passive income is rental income. Rental income is a cornerstone of real estate investment and embodies the allure of passive income for many people. It's a concept as old as property management itself, and it offers the promise of monthly cash flow from tenants. There are some significant challenges to be aware of in today's world, though. Let's cover the pros and then get into some of the challenges that we can be aware of with rental income. The most direct benefit from rental income is the regular monthly payments from tenants. This steady cash flow can cover mortgage payments, property maintenance, and still potentially leave profit for the owner. Over time, real estate typically appreciates in value or goes up in value. This means that while you're earning rental income, your property could also be increasing in worth. This can lead to a significant return on investment if you choose to sell. Rental property owners can deduct a variety of expenses from their taxable income, including mortgage interest, property tax, operating expenses, depreciation, and repairs. These deductions can significantly reduce your tax bill. Rental income can also serve as an effective hedge against inflation. As living costs increase, so can rent prices, which means your income stream can grow over time and maintain its purchase power. Real estate also allows for the use of leverage or using borrowed capital to increase the potential return of an investment. With a relatively small down payment, you can control a property and start generating rental income. But for anyone that's seen the news lately or followed tenant laws in some states, there are some serious drawbacks to rental income. Let's dive in. So the elephant in the room, Dealing with tenants can be a challenge. Late payments, property damage, legal disputes over eviction can all impact your income and your peace of mind. Property requires ongoing maintenance and the occasional repairs, which can be both costly and time consuming. Unexpected issues like a leaking roof or broken furnace can eat into your profits. A property without tenants generates no income, but still incurs cost. Vacancies can occur between leases, or you may struggle to find tenants in a weak rental market. The real estate market can be unpredictable. Factors like economic downturns, changes in local employment rates, or new housing developments can affect both rental income and the value of your property. Unlike stocks or bonds, real estate is not a liquid asset. So selling a property can take time, and market conditions can affect both how long it takes to sell and the price that you can achieve. So how do we manage this risk when it comes to rental income? We can thoroughly research the market to find a property in an area that has a high rental demand and potential for appreciation or for the price to go up. We can also evaluate our potential tenants to minimize issues and ensure a reliable income stream. We can also set aside a portion of our rental income for unexpected repairs and vacancies. It's definitely smart to familiarize yourself with landlord-tenant laws in your area. That way you can navigate disputes and manage your property lawfully. If direct property management becomes too burdensome, a property management company can help you with day-to-day operations for a fee, making your rental income even more passive. Considering all factors, 9 out of 10 is my rating for rental income. Our fourth passive income investment is index funds. Index funds contain multiple stocks within them. So by buying one fund, you get multiple stocks. They are also one of the most hands-off approaches that you can have to growing your wealth. When you buy an index fund, instead of buying one stock, you're buying a combination of stocks in a particular sector. Essentially, we get greater diversification and lower risk, and usually at a low cost. It's simple, and the potential for growth makes index funds a popular choice for those of us seeking passive income. So let's break down the pros and cons. One of the standout benefits of index funds is their instant diversification. With a single purchase, investors can own a piece of every stock in an index. This spreads out the risk and reduces the impact of any single company's performance on your overall portfolio. Index funds typically come with lower expense ratios than actively managed funds because they're not paying for a team of analysts and traders. Lower fees mean that more of your investment goes to work for you, not to administrative costs. In reality, over the long term, index funds have often outperformed actively managed funds. The majority of active fund managers actually fail to beat their benchmark indices after fees. This makes index funds an attractive option for long-term growth. For new investors, or for those of us who prefer to set it and forget it, index funds offer a straightforward way to invest in the stock market without needing to research and select individual stocks. Index funds are transparent, and you always know what stocks you're invested in. Now for the cons. Index funds are designed to track an index, meaning that they don't pivot in response to market changes. So during a downturn, the fund will mirror the market's decline, with no strategy to mitigate your losses. As a passive income source, index funds might not be the most lucrative. While they often distribute dividends, the yields may be lower than those available from other income-focused investments like REITs or dividend stocks. Also, as an investor in an index fund, you cannot choose to exclude specific companies or sectors from your portfolio. If you're opposed to investing in certain industries for ethical or personal reasons, index funds offer little flexibility for you. Many index funds are market cap weighted. That means that companies with higher market values make up a larger portion of the fund. This can lead to overexposure to certain large companies, potentially increasing your risk. The ease of investing in index funds can also lead to a set it and forget it mentality, where investors may not monitor their investments as closely as they should. This potentially can lead to you missing shifts in your financial goals or risk tolerance. Consider pairing index fund investments with assets geared toward higher income or growth potential based on your financial goals. Even a passive investment strategy benefits from regular reviews. Ensure your investments align with your long-term goals and adjust as needed. Be mindful of where you hold your index funds for tax optimization, especially when considering potential capital gains or dividend income. And remember, not all index funds are created equally. So look beyond the major market indices to sector-specific or international index funds for potentially higher growth or diversification. 7 out of 10 is the final score that I give index funds. Moving on, certificates of deposit or CDs. They're often viewed as a fortress of financial security in the ever-shifting landscape of financial options. By depositing money in a CD, you're essentially lending your funds to a bank for a predetermined amount of time at a fixed interest rate. When that time finishes, you get your original investment back plus the accrued interest. This simplicity and security makes CDs a popular choice for conservative investors or those of us who are looking to diversify our income sources. The interest rate on a CD is fixed when you open it, so you know exactly how much money you'll receive at the end of the term. This predictability is a comforting feature for investors that want to avoid risk. CDs offered by banks are typically insured by the Federal Deposit Insurance Corporation, FDIC, up to $250,000 per depositor per insured bank for each account in each ownership category. This adds a layer of security to your investments. CDs come in a variety of terms, from as short as a few months to as long as several years. This flexibility allows you to match your investment horizon to your financial goals. Investing in CDs is straightforward, making them accessible to even new investors. There's no need to analyze stock performance or market trends. You simply choose your term and lock in your rate. Generally, CDs offer higher interest rates than traditional saving accounts, making them an attractive option for part cash that you won't need in the immediate future. While safer, the returns on a CD are typically lower than those you might achieve with stocks, bonds, or other high-risk investments. This could lead to opportunity costs or missing out on earning a lot of money, especially when the market rises. But CDs do tend to offer more safety, so that's the trade-off. Also, the fixed interest rate of a CD might not keep pace with inflation, which potentially chips away at the purchasing power of your returns over time. And of course, in high inflation periods, this risk is even higher. Also, using your money before the CD matures usually comes with steep penalties. This can eat into your interest earnings and even hurt some of the principal. This makes CDs less liquid than other forms of investment. Additionally, if you lock in a CD when interest rates are low, you could miss out on higher returns if rates return during the term. This can also work in your advantage if you lock in interest rates right when rates peak. The interest earned on CDs is taxable as ordinary income in the year that it's received, which could affect your overall taxes, especially if you're in a higher tax bracket. Interest rates on CDs can vary significantly from one financial institution to the next. It pays to compare rates and terms and to find the best fit for your financial goals. Consider a CD ladder strategy, where you invest in multiple CDs with staggered maturity dates. This approach can provide both regular income and flexibility, allowing you to take advantage of rising interest rates over time. Some banks offer CDs whose interest rates will adjust with inflation, so this potentially can mitigate the risk of inflation, doing away with your returns. Ensure that your CDs fit into your broader financial plan. They're best suited for funds that you won't need in the near term, given the penalties for early withdrawal.
I rank CDs a bit lower at 5 out of 10.
All right, let's talk about bonds. Bonds are like lending money to somebody you know, like the government or a company. In return, they promise to pay you back with some money over time. Bonds are popular because they can provide a steady and predictable income, which makes them a good choice if you want a safe way to grow your money. When the bond reaches its end date, called the maturity date, you get back the original amount you loaned, which is called the principal. Bonds are great for people who want a reliable source of income like retirees, and they're generally safer than stocks, especially if you keep them until they mature. By including bonds in your investments, you can balance out the risk of other more unpredictable investments like stocks. Bonds come in a variety of flavors, from very safe government bonds to riskier corporate bonds, so you can pick your level of risk that you're comfortable with. Some bonds, like municipal bonds in the US, don't even make you pay taxes on the interest, which can be a big plus if you're in a high tax bracket. But bonds have some downsides too. If interest rates go up, the value of your bond might go down, especially if you want to sell it before it matures. Bonds also usually don't grow your money as much as stocks might over a long term. And there's also a chance that the person or company that you loaned the money to might not be able to pay you back, though government bonds are usually pretty safe. Another thing to watch out for is inflation, which can make the money you earn from bonds worth far less over time. To manage these risks, it's a good idea to spread your money across various different types of bonds and maturity dates. Paying attention to interest rate trends can also help you decide when to buy or sell bonds. Just like with CDs, creating a bond ladder where you invest in bonds that mature at different times can give you a steady stream of income while protecting you from big interest rate changes. Lastly, make sure to check out how reliable the bond issuer is, especially if you're investing in corporate bonds, to avoid losing your money. In times of high inflation, you might want to look into bonds that are protected against inflation, which can help your income keep up with the rising prices.
And 6 out of 10 is my final rating for bonds.
So comment below which of these 6 passive income investments best align with your investment strategies, and if you choose to subscribe, it greatly helps the channel. I'm Sid, and I'm out.